Hello and welcome to Blythe Ray Business News. Today we're going to be talking about Sylvania Platinum, listed in London with a ticker of SLP, a market capitalisation of around £145 million sterling. Sylvania Platinum produces platinum group metals, PGMs, in South Africa and is a regular payer of dividends. Now, today we're joined not by the company, but by Ben Davis, a mining analyst at Liberum, Liberum Capital, who are the corporate broker of Sylvania. Ben, welcome on the show. Your first time. Don't want to put you too much on the spot, but as the house analyst, you probably look at these results with a keener eye than many of us. But let's look at the interim results from last week. From your perspective, the market's perspective, what were the key highlights that came out of the results?
Thanks, and thanks for having me on. It was probably a more kind of boring set of results the market was anticipating. I mean, we had the shares are down year to date about 32%. So you always worry that, the market's feeling there's going to be some serious gremlins in those results. But, everything that Sylvania has shown so far is certainly the resilience of their operational track record, which we had out with the quarterly results, their balance sheet, $107 million of cash still there. It's in a very robust position. So from the actual results themselves, the interims, the only highlights that you're really kind of trying to extract there are the dividend, as you mentioned. And, obviously when the market gets weaker, possibly that you do worry that whether the companies like this are going to commit to ongoing dividend payments, but they did. And so, that was they declared a 1p interim dividend, which was exactly in line with what we were thinking, and based on their dividend policy, which they're continuing with, that would mean a 2p dividend payout at the finals, in the very least. So that would be 3p, which is sort of equivalent to about 6% yield based on the current share price. The other interesting part for Sylvania at the moment, certainly from an equities perspective, is their new JV with the Thaba JV, which they're sharing with Chrometech. That's all on time, on budget. So that is going to be, that's their first real venture in growth outside of the deal that they have with Samancor. Now, no one in the world is ever going to replicate quite the contract that they have with Samancor, where they get all the PGMs for free and just give back the chrome. But this deal which they've struck is basically that they it's a 50-50 joint venture split, but they are paying for the capex up front, of which then they get paid back for. Now, for this deal, since it was announced, I think it was back in August last year, that's just looked better and better, because while PGM prices have been falling, we've now been seeing actual chrome prices continuing to go up. So very attractive from Sylvania's point of view that they've got this, and that's all on track and on budget. So market coming to this results was looking for something pretty nasty, and to be honest, I just haven't seen it.
Okay. Well, look, let's just come back to that Thaba joint venture. As you said, it's chromium. My understanding is they're hoping to be producing chrome in the second half of next year. Just why should the market be excited about this? Why about chromium? And what's it adding to Sylvania's portfolio?
Yeah, absolutely. So, I mean, for Sylvania, this is a pure play PGM play, as you mentioned at the start, purely platinum group metals, which a significant amount of that revenue basket is based on auto catalyst demand, which, for many people, it's quite difficult to determine how enduring that strength of demand will be with the kind of the oncoming electric vehicles. We think it will last longer, and actually there's some interesting articles out today in Financial Times on hybrids doing better than expected. But for chrome, this is ultimately a stainless steel ingredient, and that's a element of diversification for Sylvania. They're already chrome producers, they just don't get the chrome revenue for it. This deal gives them that element of diversification, plus a nice chunky step up in growth versus where they are today, because they've done all they can really in terms of the sort of grinding out efficiencies and recoveries. Well, actually, there's probably still a bit more to go, possibly, but it gets harder and harder. So from this is kind of their first stab at sort of inorganic growth outside that Samancor engine.
Okay, so chromium exciting. Let's just come back to the PGM market, because that really has caused the pricing has caused some difficulties with the platinum group metals producers. What can you say about the current market conditions, and how has Sylvania fared in relation to its peers?
Yeah, absolutely. I mean, it's a definitely. I mean, certainly from where we came from over the past couple of years, where we had astronomically high PGM prices, prices have fallen significantly, particularly rhodium and palladium, that were driving a key part of the basket. That basket price, certainly in rand terms, has been flat now for the past 8 months, but it's still at a level which is incredibly painful for pretty much the majority of the industry, especially once you look on a post capex basis. So we're at this stage where we should be expecting the PGM producers to looking back at cutting back supply in a help to readdress the market, or to get prices to go higher. Now, we haven't really seen that in significant size yet. We've seen job cuts announced, particularly Anglo Platinum, 3,700 jobs, Sylvania, another 2,600. Impala, I'm sure, will have something to say when their results come round. But in terms of actual shutting down shafts, no one's quite in the majors making the hard decisions to take supply offline. The only material supply outage we've actually seen is the Russians, and that's because sanctions are hitting them and they can't do their smelter rebuild at Norilsk Nickel. So we're still at the sort of the crisis point. It's very difficult to see prices going lower. As I mentioned, majority of the industry is already cash destructive, but there's so much of it because it's such a dominated Russia South Africa supply picture. If we do start seeing supply cuts, which I do think we will, certainly post the election, which is now slated for the end of May in South Africa, for me, the way that demand will then react when they see supply suffering is to then stop destocking, which we think has driven a lot of the price action over the past couple of years, and actually start restocking, which would then take other prices, namely rhodium and palladium, a lot higher.
Should investors actually take some comfort from the fact that Sylvania is already in the lowest quartile of cost for producers?
Absolutely, and that cost position isn't. It's not a fluke, and it's certainly not a how do you put it? Under at risk compared to what the other miners are doing. For big challenge for the majority of the industry is that they're extracting PGMs from deep underground mines. Now, these mines are energy intensive and they're labor intensive. Those are the two of the big inflationary drivers, which certainly for Sylvania doesn't suffer from. For Sylvania, it's mostly to do, what the big kind of inflationary costs that they've suffered from over the past couple of years is actually more to do with reagents. So, kind of consumables that are used in the processing, which are more US dollar based, and because of the kind of obviously reflationary markets that we got through in sort of 2022, those prices went sky high and certainly push up unit costs. That's not an issue going forward, and as you've seen, hopefully we might even start seeing prices start pulling back for the reagents, whereas power in South Africa will continue to go up. Eskom is still very much in a difficult position. So as the cost structure, Sylvania is not only at the very bottom, it's experiencing the least amount of inflationary pressure. So as long as it maintains its strong operational track record, which it absolutely has done, I mean, they've only missed guidance, I think, twice in the past 8 odd years, and one of those was COVID. So they can be forgiven, for a lot of it. I mean, it should be, the kind of the best bet in terms of maintaining that lower cost position, and that's exactly where you want to be in this type of industry.
Okay, finally, just step back from the company a little bit. You mentioned South Africa there. I mean, what is the London market's view of South Africa as a mining jurisdiction?
Yeah, it comes and goes. For South Africa, it's always, people have been slowly, apprehensive about where it's going to. Where does this all bottom out? Because we've seen for some time Eskom become increasingly challenging. In recent years, also now Transnet, the rail provider, that's also certainly having weaker and weaker performances. So it's just when does this all gonna reach a bottom and start inflecting? And it's quite interesting now with these elections coming out that the ANC, the governing party, might not get the 50% of the vote, or over the 50% of vote, and might have to start seeking coalitions. What the political ramifications of those elections are, we really don't know. But it's certainly for UK investors, it's feeling more of a kind of maybe the end is in sight rather than just a terminal decline. So South Africa, the buy side actually down in South Africa is still pretty cynical, but UK is less so than they have been in the past.
Ben, thank you for that, and thank you for joining us today. That was Ben Davis, mining analyst at Liberum, talking us through the half-year results from Sylvania Platinum, which were released last week. That's it for this edition of Blythe Ray Business News. Thanks for watching.